Hey everybody, Boz here. Welcome to Financial Statement Analysis using ratios. In this lesson, we're going to be teaching you how to discuss key financial ratios to use in financial statement analysis, as well as to identify how investors and creditors evaluate financial performance. A more detailed overview, we're first going to identify the types of ratios that there are in users of financial statements, identify common ratios reported by public companies, determine how ratios can explain a company's financial performance, talk about general principles of using ratios, and then we're going to dig into a variety of ratios in the broad categories of growth, liquidity, leverage, efficiency, profitability, and market value. So let's go ahead and get into it. I love ratios. I'm excited to be here with you. Well, I wanted to start off and just say, what ratios are there and which should we be evaluating? You could do Google searches. You could look in textbooks. You could probably ask ChatGPT, just what kind of financial ratios are there? And you would get a lot of different options. I wanted to start with something the Corporate Finance Institute put together as far as groupings of ratios. They group certain ratios into what they call liquidity ratios. I think about that, how liquid a company that it is, how much cash does it have, how many current assets does it have, and can it pay off its current liabilities with that. Leverage ratios, that's going to be related to how much debt a company has, especially compared to how much equity it has, how much profitability it has, how much cash flow it has. Efficiency ratios are going to be how efficiently is a company using its assets. We could look at how efficiently it's using its total assets, its inventory, receivables, fixed assets, really whatever we want. Profitability, we're going to be looking at different measures of profitability. How much is a company taking to the bottom line, net income, or maybe to gross margin or operating income? Different measures of profitability. We're going to look at market value ratios as well. How much is the public saying that a company is worth? And then also growth ratios. So the Corporate Financial Institute does not actually list growth ratios as a separate category, but I think they're important to cover also. Now, we have to think about who is going to be, using ratios and who's going to be using financial statements. We'll start with equity investors. So those are going to be individuals or mutual funds or endowments, others that are trying to figure out, should we buy a company's stock? Should we sell it? If we already have some, should we hold on to it? And they're going to highly use things like growth ratios and profitability and market ratios. Is this company growing? Is it profitable? How much is it already valued at? They're not going to be using as much liquidity, leverage, or efficiency ratios. For example, I've never had someone, say to me, man, I really wanted to invest in such and such company, but its days receivables just aren't quite what I need. I mean, that's days receivables. We're going to cover those today. That's an important metric and something that that managers especially will look at, and that investors, perhaps could look at some point in time, but they're not the biggest that are going to be used in making an equity investment. Now, lenders. These are, individuals or organizations or groups that are determining whether to extend loans to a company, whether to purchase bonds issued by a company or an organization, and then if they are going to do that, at what interest rates would be appropriate. They're going to be using a lot of liquidity and leverage ratios. How much cash does the company have? How much liabilities does it have? How much debt does it have? Not as much things like efficiency, profitability, market value, and growth ratios. Those are all important, but as an example, you'll learn about something called a PE ratio. A lender is normally not going to have as its top metric, this company's PE ratio is 15 to 1 or 30 to 1. How does that impact our interest rate? It's just not going to be the biggest metric used. Managers, they're going to be looking at ratios for benchmarking. How is our company doing? How is our organization doing? And therefore, how they can improve. They're also going to use that in forecasting into the future and planning. They're going to be using a lot of efficiency, profitability, and growth ratios. Are we becoming more efficient? Are we becoming more profitable? Are our strategies enabling us to grow? Some of the less common one, liquidity, leverage, and market value ratios, they might not use as much. I mean, they certainly are going to look at all of these, but these are just a little less common. Some of them can even be a little bit out of their control when it's market value ratios, but they want to look at them and consider where these ratios are at and how others might view them. We've got auditors. Auditors are going to evaluate areas of risk in a company. Highly used things like efficiency ratios. Okay, the days receivables went up or the days inventories went up. Should we have more reserves? Should the company have more reserves? Ooh, there was a big increase in days payables. Is that just a strategy by the company, or are there some financial troubles? And then they might also use growth and profitability ratios. Goodwill impairment, intangible impairment, and the related valuations, you would need to use those ratios. Less common, profitability, market, liquidity, and leverage ratios. So once again, a profitability ratio. What is the gross margin ratio? If that goes down a little bit year over year, auditors are going to consider that, whether that could be a sign of problems or something of that nature. And they might do some audit testing accordingly, but it's not going to be as high as some of those other areas. Tax advisors. I spent 9 years in public accounting, predominantly in international tax, and did 17 years of consulting for a Fortune 1000 company. And I did a lot of developing planning ideas and structures. I worked with the internal personnel at the company, along with CPA firm tax advisors, tax lawyers, and we needed projections oftentimes. And that was something I would do internally in the company, is that I would come up with and facilitate projections and models that other advisors could use them. This can impact tax valuations and transfer pricing, and highly used ratios, profitability, growth ratios, leverage and efficiency ratios. A lot of it was, does this tax strategy make sense based on how profitable the company is, based on how much it's growing, based on how efficiently it's using its assets? And then less common, we didn't use as much of market value and liquidity ratios. And then kind of some others, nonprofit donors could look at financial statements of a company and say, should I make a donation? Citizens are certainly going to be looking at government financial statements and trying to figure out if a government is wisely using its tax revenues. Customers, if they want to do business with a company, they can say, okay, is this company healthy? Are they going to be a good supplier for us in the long run? Vendors. You could look at a company's financial statements, and if you agree to sell to them on credit, as an example, what are the odds that they're going to repay you? Employees. Should I work for this company? Will it sustain? I connected with an alum of our college recently, and they were considering a couple different job offers, and one of the companies was a public company. So I went out and looked at its financial statements. This company, very small company, was in a world of hurt. So one of the things I counseled the alum on is I think there's a risk that this company might have to declare bankruptcy or might be a prime acquisition target. And you might not have a job that much longer. And that alum did not go to work for that company. It was based on ratio analysis and evaluating financial statements. And then competitors. Where is this? Where is these other companies beating us? Where are they lacking us? Just so we know, where to try to get better at. So, quick review question here. Which financial statement users may be most interested in a market ratio such as the price-earnings ratio? Did you catch it when I went through here? It's not managers. They oftentimes don't have control over it. It's not lenders. They might be more interested in if a company can repay debts. Auditors are going to be more focused on ratios which might indicate a company's risk. It is going to be equity investors. Equity investors are going to say, okay, this company looks really healthy. as an example. It's growing, it's profitable, but you know what? Everyone else thinks so too. So these market valuation ratios are already very high, and maybe we're gonna shy away. The next section, identifying common ratios reported by public companies. So I want to take a look at, what do companies report? And I actually just thought it would be fun to take a look at earnings releases for a couple public companies out there. We're going to look at Best Buy, General Mills, and Medtronic and just say, okay, what information do they have on the most recent earnings release? What type of financial ratios are they reporting? So in order to get here, what I do, I'm going to scroll over to Google. I'm going to type in Best Buy Investor Relations. It's a pretty good search term to use. And then I will go into here. You can see that they have their next earnings call coming up on August 29th. So I'm recording this in early to mid-August, so we're not quite there yet. I can go over to quick links, financial releases right here. Best Buy reports first quarter results. And let's just go take a little peek at it. It's showing that comparable sales declined. GAAP diluted earnings per share increased. Non-GAAP earnings per share increased. I'm looking for ratios here, like stuff that has percentages by it. And it also gives us an earnings per share amount. As I continue to go in here, I see things like enterprise comparable sales, domestic sales, international sales. I get operating income ratios. So these are items that are right there on the first part of the company's press release. We see in here, again, it's kind of like an operating income ratio. I will continue to scroll through here to see if they have anything else. They have financial statements here where they're giving gross profit ratios in a percentage, SG&A ratios, operating income ratios. In the balance sheet, you can see it's really just numbers. There's no ratios. In the cash flow statement, you can see it's numbers. There's no ratios. Segment information, they're showing change in sales and profitability type of ratios right there as well for the domestic and international segments. They are kind of breaking down their sales by their segments. To see where they have most of their sales, and then we're most of the way through those through the financial statements. So that's an example of what Best Buy had. All right, the next one, let's go to General Mills. So I'll back up in my search history. Now we'll go to General Mills Investor Relations. I usually just click on the first one to see what I find. I could always have clicked on one of those links as well. Sure, I'll take your cookies, General Mills. You're a food company. Financial news. Doesn't look like I want it there. Okay, General Mills, fourth quarter fiscal 2024 earnings. We've got our press release right here. There we go. It's saying net sales decreased 1%. Operating income was up 4%. It gives earnings per share information and how much it was up. It's given the same metrics for the fourth quarter. We have some narratives here. Looking to see if they have a chart. Yep, you can kind of see what percent their sales were up or down in a variety of their markets. We're looking at that one again. Trying to think, okay, here they have segment operating profits, so similar to operating income. Where do they have more profits versus not? You can see there's some saying, how did it change, probably compared to the previous period? How did it change in constant currency? I mean, excluding foreign currency. So I'm just kind of scrolling through a little bit to see what items they pop out in their headlines. And a lot of it was sales growth and then operating income percentages. I don't need to go through all of these, but you can see that they're showing a percent change for all of their items. So yeah, there's General Mills. Now we'll take a look at Medtronic. I'll get out of this one. Just trying to think, what is it that companies are highlighting? Right? When we think about what ratios we should use. All right, August 20th, we're not quite there. I'm actually pretty close to that one. I'll go down to quarterly earnings, the fourth quarter press release. Medtronic, I think they have an April 30th year end. And let's look at their headlines right here. You know, how much are their revenues changing by? What is their earnings per share? What is the revenue change for the full year and earnings per share for the full year? How has their cash from operations changed? That's the amount of their share purchases. That's not really a ratio. Dividends, I guess they're saying how many, what they have for dividends per share, and then some financial results. So again, we see a lot of their headlines right here. What I'm trying to say, it's really, you see a lot of focus on revenue changes, earnings per share changes, operating income as well. So that's where we're seeing a lot of items. And I just thought it would be fun to do just one random other one right here. And I'm just going to do this live in this session and see what I find. I am going to go over to an Excel file I have open here with the Fortune 500 companies. And just to kind of take away any sort of bias here, I'm going to do a rand between. It's one of my favorite Excel features. 1 to 500, and it says 455. I was hoping it was going to be higher. We're going to find out. 455 APA. All right, I have not heard of them, but they're an $8 billion mining and crude oil production company out of Houston. We're going to see how this works, but I just want to see what APA is reporting, just so you are not thinking that I had all of these kind of penned in advance as far as what sort of ratios were going to be released. So APA, Investor Relations. I'll have to see if this is the same one down there in Houston. I'll go ahead and I'll click on it. We'll see what it pulls up here for us. Took a few seconds, so I paused it. And here I've got APA. I'll go into its earnings release. Yeah, it looks like a mining company. Okay, here we've got the key takeaways up front. What do they have? So yeah, as far as ratios they have, a ratio is not just a dollar amount. I usually think of it in percentage terms. They're looking at oil production increase, right? So that's going to be something that they're looking at for a couple quarters here. Just trying to think if they have anything. They're reporting earnings per share. A lot of dollar amounts. They're talking about oil production. I'm just going to see if they have any quick little financial statements in here. They should pretty soon. Never looked at them. Yeah, just dollar amounts on this one. If we're looking at it, looks like they do actually look at ratios for oil volume, natural gas volume. They're looking at barrels per day and some other metrics that way. So just kind of financial ratios that maybe are meaningful for their industry. All right, that's just what I wanted to do, is just kind of pull up a random one just to see what kind of items that companies are reporting. So which of these is not a common ratio that a company discloses in their earnings releases? If we think about that. And actually, we just kind of went through some of those. Revenue, that's almost always disclosed. Earnings per share is almost always disclosed. Operating income percentages are frequently disclosed, but with none of those did we see days inventories. All right, so we're just thinking about common ratios that companies use. All right, the next thing we're going to do is determine how ratios can explain a company's performance. So we're looking at a company's financial statements right here, and we see for 2022 and 2023 that this company has about $26 billion worth of revenue. Now, its stock price in May of 2023 was the same as it was in November of 2021. The stock price then more than quadrupled over the next 13 months. So we're trying to figure out maybe why that happened. Well, here is why that happened. We can see that as a couple of years passed, and I was just kind of doing snapshots as far as this company was concerned and its stock price, but this company exploded in terms of revenue. This company by 125%. This company's gross margins went way up from 57% to 73%. Their operating income was up about from 15% to 54%. This company is NVIDIA. So NVIDIA exploded. They're now one of the most valuable companies in the world, and its financial ratios would also support that. Another example here, we have a company that revenue peaked in 2021, but then over a 2-year period, they saw their revenues decrease by about 31%. Their gross margins, which is gross margin divided by sales, went down from about 55% to 40%. Their operating income used to be about 25% of sales. It crashed basically to zero. And the stock price was down 38% since the beginning of 2022. This is Intel. It's had a really rough couple years. We have another company here that over a 4-year period, so I'm just comparing December 31st of 2019 to December 31st of 2023, but over a 4-year period, its revenues are up 185%. Its gross margins were 53%. They decreased down to 40%. Operating expenses were 120%. They're down to 37%. And the stock price more than doubled over a 4-year period. This is Uber. All right. So we can see how ratios are impacting how a company is telling us more about the company performance, and then maybe why valuations of the companies are what they are. Well, the impact of debt ratios. At the end of their most recent years, Disney had $46 billion of debt. Hertz had about $15 billion of debt. So which company thus had a worse bond rating and a higher interest rate? Now, if you just looked at that really quickly, and if you have not done a lot of financial statement analysis, you might say, well, that sounds like Disney. They've got more debt, right? Well, as of September 30th, 2023, which is their most recent year, they did have debt of $46 billion, but their equity was over $100 billion. Their debt to equity ratio was less than 1-to-1. It was 0.45 to 1. And for bonds that they have that are maturing in 6 years, they have a bond rating of A minus, which is pretty good. That's a strong, healthy company, and a yield, which implies an interest rate of less than 5%. Now, Hertz, on the other hand, while they only have $15 billion worth of debt, their equity is only about $3 billion. So less debt, but a lot less equity. Their debt to equity ratio is thus about 5-to-1. Their bonds maturing in 6 years, their bond rating is a B minus. That's pretty low. You kind of want to be at something called a triple B or better to have a good bond rating. And their yield or their interest rate is about 15%. So it's just kind of showing you can't just look at a number. You need to look at a ratio like a debt to equity ratio to get a true measure of a company's health and its performance. You can't just look at debt because we got to compare it to other metrics. A lot of debt might not be bad if you have a lot of equity or a lot of profits or something like that. Conversely, a little debt might be bad for some companies if they don't have any equity or any cash flows or any profits. So this review question, let's say a well-established company which sees revenue increase, which of these would they generally not see? So think about examples that we showed there for Uber or NVIDIA. Right? These were well-established companies. They saw revenues go up. Which of these did we usually not see? Well, a gross margin increase in dollars, that's incorrect. If you're well-established and your revenues go up, you should probably have an increase in gross margin. Gross margin increase as a percentage of sales, you're probably going to see that as well because your fixed expenses are going to be spread over a larger amount of sales. So if you're a healthy company, revenues go up, your gross margin percentage probably goes up as well. Operating income increase in dollars? No, it's incorrect. You probably are going to see that, right? You're going to be making more profits. Operating income decrease as a percentage of sales. That is the one that is correct, meaning when I say correct, it's because this review question says we would not see an operating income decrease, and that is correct, right? That would be less common because companies have efficiencies. They're going to spread fixed expenses over more sales. Well, general principles of evaluating ratios here. First of all, the companies that we're going to look at, we're going to look at some Minnesota headquartered companies. 3M is a diversified manufacturer, sells a lot to retailers. Ecolab, water treatment, cleaning products, sells to businesses. Hormel, they're known for their food product Spam, and along with some others, branded food company, sells to grocery stores. Target is a retailer, sells to consumers, largely individuals. United Health Group, they're managed healthcare and insurance. They sell quite a bit to businesses, but also some directly with individuals, and they work with insurance companies. Also, Xcel Energy is a utility company, which is going to sell businesses and individuals, whoever needs their utilities. Now, companies we're going to look at outside of the U.S., outside of Minnesota, I'll call these notable companies, would be Amazon. We know their online sales business. They also have a very rapidly growing and profitable cloud computing group called Amazon Web Services. They sell to individuals and businesses. Apple, we all know them, electronic software, online services going to individuals and businesses. Boeing, all right, aircraft and aerospace manufacturer. They're selling to other airlines and to the government. And then Johnson & Johnson, the world's largest healthcare products company, they're selling to individuals and businesses. Usually think of them going a little bit more to businesses than individuals. Now, we're going to look at those companies, and we're going to look at ratios, a bunch of them for these companies. So a lot of just practical examples. We want to make sure we don't look at these in isolation. We want to compare them to a company's own performance over time, compare them to a peer's performance over time. We're going to do a lot in this session right here about comparing companies to other companies. And when we want to compare to a company performance over time, we got to understand that some ratios are naturally going to change. You can't grow at a high rate forever. So if growth eventually slows down, that's kind of expected. And then also, early on, it's tough to be profitable if you're investing quite a bit in research and development, if you're investing in marketing. We want to make sure we exclude one-time items. If a company has an intangible asset or a goodwill impairment, it's probably not going to happen every year. If it has a significant restructuring, we might want to exclude that as well. Now, we want to be careful that those one-time items don't simply recur every year. We joke that those are called recurring, non-recurring items. If they are, then we should probably consider them. We also want to understand that improving in one area could cause issues in another area. So if we try to drive sales growth by expanding the inventory selection, relaxing payment terms or credit standards, we could get good sales growth, but we might have excess inventory. We might have receivables not getting collected as quickly. So that's not a bad thing, but just there can be some business changes which impact ratios. Now, when you're comparing to your peers, you want to make sure that you are, identifying peers and aspirants. Aspirants means companies or organizations that are doing a little bit better than you. Try to identify at least several of them, and then focus on ones that are in the same industry, right? So I work in higher education, and I wouldn't compare our university's financial statements to those of Apple or Amazon or Boeing or something like that. I might compare our financial statements to other higher education institutions, maybe some that are like us, and then maybe some that are a little bit larger and have had stronger growth to try to figure out, what they're doing right. You can also look at the full range when you're comparing to peers, but investors or just any ratio users will oftentimes look at medians and averages to exclude outliers. And then beware and limitations in your organization's strategy, which will make it impossible to measure up to peers at times. Target's never going to have the same turnover ratios of Costco or Walmart. Target is going to win on a little higher margins. Costco and Walmart, they're going to win. They have low prices, which is going to give a huge amount of volume and turnover. Some banks might have more aggressive approaches or value customer service, which would result in higher margins compared to the maximizing just the number of loans that what they processed, and maybe there would be then lower margins, but more loans out there. So just being aware that the strategy will impact the ratios. So if you're comparing to another company that has a slightly different strategy, like if you are a credit union or a local small town community bank and you're trying to compare yourself to US Bank or Wells Fargo, you're going to see your profitability is probably better, right? You have a little higher interest rates, but your return on assets is probably not going to be as good, as an example, because you're not cranking out as many loans. So not a good nor bad thing, but just make sure to compare to appropriate peers. So this review question, a company should compare its ratios to which of the following? Only its own past ratios? Nope. We also want to look at competitors. So not only competitors, we also want to look at our own past performance. Neither of those two? Nope, not at all. We want to compare to both our own past ratios as well as the ratios of our competitors. Well, let's actually start digging in and getting into some real ratios with some real companies here, and we will start with growth ratios. Growth ratios are not necessarily the first ones that are taught. Again, when we went back to that Corporate Financial Institute, that was not one of the ratios that they had identified, one of the groupings, but we look at what the companies reported. Companies are reporting growth in sales, growth in earnings per share, right? So growth ratios, in my opinion, are perhaps the most critical ratios. Percent change in revenues, current year revenues minus prior year revenues divided by prior year revenues. We could look at percent change in earnings per share, current minus prior, divided by prior. All right, these are two of my favorite growth ratios. Now, to understand these terms, we need to understand what is meant by revenue growth. Some companies will just say total revenue growth, or if they don't use the word total, if they just say we grew revenues by 8%, that implies total revenue growth. Some will use the term organic or same store or core. And what that oftentimes means is that it will exclude things like acquisitions or new stores or foreign currency, as an example. Revenue growth is a function of both the change in how many units you're selling and then also the selling price. So there's two ways to increase revenues. And then hopefully a company is slowly increasing both of those, all right, because that will mean it's gaining market share and customers are willing to pay at least an inflationary premium for its products. Now, if a company is growing earnings, why do we care if it is growing revenues? And the point I'm trying to make on this one is if you see a company growing earnings, but it's not growing revenues, by definition, it must be cutting costs. And at times that's good. It's good to control costs, but you can only cut so many costs. Eventually you get to the point you can't cut any more costs. There's nothing left, all right? So I find it healthy if a company is trying to grow earnings that it's also growing its revenues. Now, for nonprofits, revenues can mean donations, as an example. So just be aware of the industry that you're in. In government, revenues are primarily from taxes, which might be policy decisions by lawmakers. So the local government might not be able to control that. In higher education, the space that I live in, revenues can be from enrollment as well as in donations or draws off of an endowment. And a big thing in higher education is you really, want to get a strong first-year class, because if you have a strong first-year class, you're going to be getting tuition and room and board revenues for 4 years. If you have a bad year of enrollment or a weak first-year class, now that's going to impact your financial statement for 4 years. So within revenue growth, we are going to look at the 10 companies that we identified. And again, this is current minus prior revenues, all divided by prior, and the median was 2.4%. Now here's the list of companies. When you look at these companies, and again, I'm recording this video, it's early to mid-August of 2024. I'm using the most recent year end. So for a lot of companies, for the most of these, that's calendar year end. Not all of them, but for most, it's calendar year end. Which of these over the last year has grown revenues the most? Here's your list. Boeing grew them the most, then United Health, then Amazon. The struggling ones at the bottom, you can see Apple, 3M, and Xcel Energy. Now, if we want to look at earnings per share growth, and then we're going to kind of go back at the end and look at kind of some reasons for these things. So actually, I should probably just deal with revenue growth right now. I mean, Boeing, the one thing about Boeing, they were down. Okay, so Boeing is rebounding from some struggles that they've had. Amazon continues to kind of kill it with their Amazon Web Services. Xcel Energy, we just saw energy prices come down. 3M's kind of had a rough go of it. And then Apple, I mean, that's a situation. I mean, Apple, it already is at a very, very large point. You know, you don't necessarily see a lot of new people getting iPhones. The people already have the iPhones and they're periodically just going to be replacing it. One of the things, I mean, I'm actually finding phones to be more dependable these days. So I used to kind of trade in a phone every 2 to 3 years. My last one lasted me over 4 years. That means that's one fewer phone that Apple can sell. All right, back to earnings per share growth here. So equity investors in large public companies generally expect returns of about 8 to 12%. And I like to look at that. That's a combination of dividends and stock price appreciation. Now, private equity or venture capital investors are going to expect probably 15 to 20% or more for risky venture capital. You know, how does a company grow earnings per share? Because between dividends and stock price appreciation, we want to see 8 to 12%. Well, to grow earnings per share, we get more net income, or we have a lower number of shares outstanding through stock price repurchases. So why is it a problem if a company that doesn't pay a dividend is only growing earnings per share by 5% or so? Okay, so we try to think about what might be reasonable to grow. 5% growth for a stable company. Well, that sounds okay for a stable company, right? But, well, here's the problem. Equity investors don't want just a 5% return on their stock. So assuming that price earnings multiples, which we'll talk about later, are constant, if we're only growing earnings per share by 5%, that means we are only going to be growing our stock price by 5%. So let's look at earnings per share here. For these companies, here are our sample companies. You can maybe make some predictions about which do you think might have more earnings per share growth versus less earnings per share growth. The median was 0.6. I usually think of earnings per share as growing faster than revenues. So revenues were 2.4%. I usually think that we're, maybe buying back some shares. Maybe we're increasing net income, spreading fixed expenses over a greater amount of sales. So I would have expected earnings per share growth to be higher. And it wasn't in this situation. But as you'll see, it was pretty volatile. So we would probably need a larger sample size to prove that out. And when we think about the volatility here, Johnson & Johnson, we could see 103% change in earnings. It means basically their earnings more than doubled. They had a big sale and they had a large gain on that sale. Now we look at a couple decreases here. We've got Boeing, we've got 3M, and we've got Amazon that had some pretty staggering numbers on the bottom end of things. Boeing has got losses due to issues with their planes. The 737 MAX planes have been grounded a couple times. 3M had a very significant litigation charge, which resulted in them having earnings per share go down. And then Amazon, their core business is doing very well, but they actually have some equity investments, and just the accounting behind those can result in some pretty large other income and other loss activities depending upon the year. Their operating income is doing great at Amazon. It's this other income from equity investments that can distort that. So I kind of throw out those examples. But outside of those, what do we see? We see, companies, all the way from Target at 49% to Hormel at a minus 20%. We can see Apple is pretty flat at 0.1%. Their revenues were down, but they must have cut expenses by, even more to get earnings per share going up that way, or maybe they did some sort of stock buyback. But we can see this. These are kind of all over the board this time. Well, how do companies handle these issues? Frequently, what they will do is they will report something called adjusted earnings. Now, I wanted to share an example from 3M's 2023 press release. So if you look up here, we can see that 3M has GAAP earnings per share for the full year of $12.63. Last year, they were a little over $10. So it looks like 3M had a disastrous year. Didn't have $10 of earnings per share, had a negative $12 earnings per share. And so it looks awful. Now, but when we see on an adjusted basis, last year was $9.88. This year is $9.24. As far as adjusted earnings per share is concerned, why is this? Well, they had two big things here. They had a settlement related to Combat Arms earplugs, and then they also had a settlement related to public water systems. So 3M is saying we had some big losses on those two settlements this year. We don't expect those going forward. So we are going to handle this by reporting GAAP earnings. You have to report GAAP earnings, but then also reporting an adjusted earnings per share that is not GAAP. But a company has some latitude in what to report there. So instead of earnings per share being down over 200%, it is only down 6%. Well, is high growth always a good thing? Percent change in revenue, I like to say that higher is normally better, but costs can get out of control. So if you're growing revenue so quick but you have a lot of losses, that can be a problem to be selling at a loss. And percent change in earnings per share, whether that's GAAP or adjusted as we saw with 3M, that's generally thought of as a good thing to have higher percent change, unless you've maybe had cost cutting just in order to meet good earnings per share for the investors in the most recent year, but then you might be concerned what is going to happen to that company in the long run. So we look at this review question, percent change in earnings per share. How do we compute that one? Percent change in earnings per share. It is not prior minus current divided by prior. It's not prior minus current divided by current. There's a couple items backwards in there. It's not current minus prior divided by current. It is current minus prior. So that's going to be your change divided by prior. So I give you a little hint there. When in doubt, use some baseline numbers. So if a company increases sales from $100 to $110, most of us would say, there's a $10 increase on a $100 baseline. That's a 10% increase in basically an increase in sales. So I always just say make sure to test it with that approach. So current minus prior, take that result, all divided by prior earnings per share. All right, let's go into another set of ratios. How about the profitability ratios? So profitability ratios, one of the first ones is going to be the gross margin ratio, which is going to compare gross profit of a company to net sales. It's going to show how much profit a company makes after paying for its cost of goods sold. That's gross profit or gross margin divided by sales. This one is a pretty good indicator of how much a company can mark up its products by. How valuable are this company's products? The operating margin ratio, sometimes it's called return on sales, but it compares the operating income of the company to net sales to determine operating efficiency. You can see the formula is operating income divided by net sales. It takes gross margin, but it also puts in selling expenses, general expenses, administrative expenses. Some people will look at an EBITDA margin ratio, which is EBITDA divided by sales, earnings before interest, taxes, depreciation, and amortization. A return on assets ratio is going to measure how efficiently a company is using its assets. So what is income compared to assets? Return on equity, how efficiently is a company using its equity? So income compared to equity. Well, what types of companies would you expect to have high gross margins? I don't know if anything jumps out to you as you're just kind of thinking of these companies here. But service providers oftentimes are going to have lower cost of goods sold, cost of sales, I guess I should refer to it, or cost of revenues. And then also for manufacturing companies, it's going to be those with valuable patents that can really mark up their products a lot because they have patents that protect competitors from competing with them. So as we look for gross margin ratios in this list right here, we're trying to identify which are, perhaps some of the service providers, which are some of the companies with valuable patents. And then the median overall was about 42%, the gross margin ratio. Again, gross margin divided by sales. And then here's the result. So Johnson & Johnson, you think of its pharmaceuticals, it's drugs that way, basically. They have huge markups on them. They have very valuable patents. Xcel Energy, I'm going to skip those. I'll talk about that in a moment. Amazon, I'll talk about in a moment as well. But Apple, valuable patents. They mark up their products a lot. 3M, Ecolab, they mark up their products a lot. Someone like Target, Hormel, as an example. Target is just a reseller, so it's limited by how much it can mark things up. I think United Health Group is going to have some restrictions, based on insurance company regulations and so forth. In some situations, could be some government regulations. Hormel, kind of a lower value type of grocery product. And then Boeing is just having trouble making money these days. But, Xcel Energy, they don't specifically call out a gross margin line. So I did my best trying to understand what was their cost of goods, cost of sales. So I'm going to skip those. But Amazon, if we go back here, we see Amazon 47%. We wouldn't have thought Amazon was very profitable, but they have that because we think of their, basically their home delivery of products, and they can't mark those up super high, and they have shipping and distribution costs, right? But they have an Amazon Web Services segment, which is really growing and really, really profitable. Now, the operating margin ratio. Let's go ahead and take a look at this one. So again, gross margin just subtracts cost of goods sold from revenues. This one is also going to subtract selling, general, and administrative expenses. Basically everything except interest and taxes is what I usually think about it, and maybe one-time items. So what type of companies, including all operating expenses, are pretty profitable? Okay, the median, remember, for gross margin was 42%. For this one, it's 8.8%, so it falls quite a bit. Here is your list. So now, Apple's still very high. Apple is that's why they are always, one of the top couple most valuable companies in the world. When I think about most valuable companies, I'm generally thinking about Apple. I'm thinking about Microsoft, NVIDIA as of late. Amazon kind of depends on the year, but Apple sells a lot of stuff at really high prices. Johnson & Johnson is really high, but remember, Johnson & Johnson, their gross margin ratio was extremely high. So this one has fallen, their gross margin was like 68%. So this has fallen quite a bit. Why? Because they have an enormous amount of product development expenses. And then the other one to call out would be 3M with that loss, and they had a large litigation charge, and that's what's actually keeping that's what put 3M into a negative with its operating income. I like to look at gross margin and operating income ratios. All right. And the difference is going to be SG&A expenses. So 3M, again, 3M is the one that had a litigation charge. That's why its SG&A expenses are so high as a percentage of sales. So kind of ignore that. That's a one-time thing. But Johnson & Johnson, huge product development. Xcel Energy, all their infrastructure. So Amazon has a lot of infrastructure behind that. Now you see something down there like Hormel at the bottom. They don't have a lot of selling general and administrative expenses. Not seeing Hormel with a lot of new product development, not a lot of research and development, not a lot of marketing. Right. And then Apple at 14%, that's pretty low compared to most companies, as you can see. SG&A expenses. They certainly do have product development and selling expenses and administrative expenses, but compared to sales, they're a lot lower. And I made the comment already about 3M with their large litigation charge, and their operating income margins would have been over 20%, excluding that charge. Now, the EBITDA margin ratio, EBITDA margin is going to be EBITDA divided by revenues. I will just kind of, this one is 13% is the EBITDA margin ratio. Remember that operating margin was 8.8%. All right, so we're looking at that, and just the EBITDA margins are about 4% higher. Now, to me, we're going to unveil the results on this one, and this is going to be a little bit difficult just to see. We had just gone through operating income percentages. Here's EBITDA percentages. So I'm going to skip a slide ahead here, and I'm going to do a comparison between EBITDA and operating income. But first, what types of companies have EBITDA margins much larger than operating margins? They're going to be companies that have a lot of depreciation and amortization. EBITDA margins are always going to be higher because they exclude depreciation and amortization. So companies that have a lot of those items are going to have higher EBITDA margins. Why do many investors prefer EBITDA over operating income? And that's because depreciation and amortization are non-cash items. Now, companies also have capital expenditures, which do not decrease income, but they are a big decrease to cash flow. So for that reason, I actually prefer operating income percentages compared to EBITDA. I just think it's closer to cash flows when you're including capital expenditures. That said, a lot of mergers and acquisitions specialists, private equity, venture capital, M&A folks, things of that nature, they talk in EBITDA margins. So it's I see that one used probably even a little bit more. So what I like doesn't necessarily matter. In theory, capital expenditures are a cash flow item. So in theory, like free cash flow margins might be best, but that's just not as readily available on a company's financial statements. Well, if we want to compare them, will EBITDA margins always be higher? Yes, because they exclude depreciation and amortization. You'd have to have a company with negative depreciation or amortization. I don't even know if that's possible. You'd have to have some weird, I don't think that's possible. It'd have to be some weird negative. I don't know how you'd get there through some sort of disposition. I don't think you can. So it's EBITDA margins are always going to be higher. But compare these right here. All right. Xcel Energy has EBITDA margins a lot higher than operating income margins. Why? It has a ton of depreciation with all that infrastructure. J&J, Johnson & Johnson, it has a ton of intangible assets, right? And therefore a ton of amortization. Amazon, they also have they're developing a huge amount of infrastructure, so they have a lot of depreciation. Things like United Health Group, Hormel at the bottom, those don't have a lot of depreciation or amortization. So you're seeing a lot of, up top, I guess you see 3M, Ecolab, more capital intensive companies too, a lot of depreciation. So just a little comparison between EBITDA and operating income margins. So as with all these, we always have to look, is high profitability always a good thing? In theory, we would want high gross margins compared to net revenues, but we have to expect that competitors are eventually going to catch up. So we are going to have a decline at some point in time. And then in theory, operating income and EBITDA margins being higher, that's a good thing, except maybe are we not selling enough stuff? Maybe could we increase turnover? Should we be lowering prices a little bit to get more turnover? And maybe we would have lower margins, but we would make up for it on the turnover side and be better overall as a company. Well, review question number 6 here. So which ratio will usually yield the highest percentage? EBITDA, operating income, profit before tax, or profit margin? I actually didn't even look at all of these, but operating income is going to be higher, as it's going to exclude depreciation and amortization expense. EBITDA will be higher because it'll exclude those. Profit before tax is going to be pretty low. It's not a commonly used ratio. The profit margin, we didn't really get into that one, but that's net income divided by sales. It's probably going to have the smallest percentage. So of the 4 listed, the EBITDA ratio is the one that's going to be the highest. It's going to exclude depreciation and amortization expense. The only ratio that's usually higher is the gross margin ratio, because that will exclude other operating expenses. Well, time now for liquidity ratios. When I think of liquidity ratios, I'm thinking about cash more than anything, all right? How liquid is a company? So liquidity ratios here, the current ratio, this is a very popular one. What are current assets compared to current liabilities? Acid test ratio, current assets, but subtract off inventories and then compare those to current liabilities. Current ratio is like, do we have enough current assets? And those are the items which are going to be cash in the next year to pay off our current liabilities, which are items we have to pay off in the next year. So you can see the importance. The acid test is like, well, there's no guarantee you're going to sell your inventories or quickly. So we want to know, not relying on your inventories, how quickly that you're going to be able to pay off your current liabilities, mainly with existing cash, short-term investments, and accounts receivable. The cash ratio is just cash versus current liabilities. I personally don't think that one is as useful, just because accounts receivables are, if they're computed properly and the reserves are done properly, you generally can count on collecting those within a prescribed time frame. And then operating cash flow ratio. What is your operating cash flows compared to your current liabilities? This, in theory, would be my favorite, but operating cash flows are a little bit more complex to compute. So we generally see the current ratio more than anything. Now, the more stable a company is, the less liquidity it needs. A lot of people, don't necessarily realize that, but I'm going to go through that with an example. Startup companies, they often need to secure financing to ensure liquidity, and startup companies might sometimes have the highest current ratio. Again, we got more of that upcoming. So we can look at our 10 sample companies here. Which of these are going to have higher versus lower current ratios? And I'm not going to spend a lot of time on this one. The median is very close to 1.0. It's actually 1.1 current assets to 1 liability. So it's 1.1. And here's the companies. As you can see, they're all in the ballpark of that average of 1.1. Hormel, a little bit higher, and Xcel Energy United Health Group a little bit lower, but no huge outliers. So a current ratio of at least 1.0. Many people believe that a high current ratio is where you want to be and that you want a current ratio of at least 1.0. I don't necessarily agree with that. Sometimes I will, but I won't always, all right? And in fact, if we looked at this one, we would say that, because if it's less than 1.0, it sounds like the company won't be able to pay off its current liabilities with its current assets. So you can see why people like to see a current ratio of at least 1.0. And if a company can't pay off its current assets can't pay off its current liabilities with its current assets, what's it going to do? Well, it could borrow cash. We think about what else other than borrowing cash. Let's take a peek here. So the Walmart case. So as of January 31st, 2023, Walmart had current assets of $76 billion and current liabilities of $92 billion. It looks like Walmart's going to go bankrupt. It doesn't have enough current assets to pay off its current liabilities. Holy smokes. We've identified that Walmart stock should be worthless because they're going to go bankrupt, right? Not so quick. You know, what did it do? Did it borrow? Did it sell assets? Did it issue stock? It didn't do any of those. Its debt decreased. It didn't, have any big asset sales. It didn't get rid of all their Sam's Clubs, as an example. It didn't issue new stock. What else could a company do? And this is the one that gets a lot of people, all right, that they don't fully know what else can happen. Well, what they did is they generated a lot of cash from their operations. So over that next year, they generated $35 billion of cash from operating activities, and it used that cash combined with its current assets to help pay off its current liabilities. So higher the current ratio, not always a great thing. Now, if you're a startup company and you don't have and you don't have cash flows from operating activities, then you got to have a plan in place, right? So, is higher liquidity always a good thing? Well, we just saw the current ratio. The higher is normally, I consider it conservative, not good, but it's a financially conservative strategy. But conservative strategies, they can lower a company's returns. Apple, they have about $160 billion of cash and investments on their balance sheet. It earns $3 to $4 billion each year on those assets. $3 to $4 billion sounds like a lot until you step back and you say, that's only about a 2% return. Shareholders want you to be getting a return probably of at least with Apple. They probably want Apple to be getting a return of at least 8 to 10% on its assets, right? It's a fairly safe company, so maybe lower returns. So that's not a great return. Now, Apple, they generate about $100 billion of cash each year, and they give it back to shareholders through dividends and stock buybacks. They basically have nothing else to do with it. They haven't found any huge acquisition opportunities, as an example. But the point is maybe they should do more. All right, to sit on $160 billion of cash is not necessarily where Apple should be. So it's a very safe strategy, right? Apple is not going to go bankrupt anytime soon, all right? But they're lowering their returns that way. And I guarantee you that is something that the CEO, CFO, and treasurer of Apple, along with their board of directors, are thinking about a lot. It's just like, do we have too much cash on our balance sheet? Should we do larger dividends or more likely share repurchases? So review question number 7. If a company has a current ratio of less than 1.0, which of these is true? You can take a quick peek. It is not conservative, all right, if it's less than 1.0. It does not have high cash receivables and inventory. Probably compared to current liabilities, those are lower. It won't likely go bankrupt. All right. Some companies can keep their current ratio low. Walmart's was down there at about 0.8. Okay. I mean, it could be a risk, but it's not like it's most likely going to go bankrupt. But yeah, it's aggressive with its liquidity strategy. All right. So it's just minimizing the amount of assets that it's holding that aren't generating strong returns. And as a result, it can get higher overall returns for its shareholders by having fewer lower returning assets. Leverage ratios. Getting into this next section here. So with leverage ratios, we've got a debt ratio, which is liabilities compared to assets. Okay. What amount of assets are from debt? We got the debt to equity ratio. How do we look at its liabilities compared to equity? Interest coverage ratio, operating income divided by interest expense. Debt service coverage ratio, operating income divided by total debt service. which is kind of the interest expense you have to pay on your debt, as well as any required principal payments. And then the leverage ratio. This was not one that was listed by the Corporate Finance Institute, but I just kind of added it on here. And that is debt to EBITDA, and that is a popular metric, perhaps the most popular metric that I see companies use. So I wanted to put that on here. So common debt covenants. So generally, we compare debt or an income item with expense items to try to determine how risky a company is with its leverage, or how much leverage that it has. Debt to EBITDA, that would be one thing that we could compare, or operating income to interest expense, the interest coverage ratio, a couple very popular metrics. These are done by bond rating agencies. These are done by banks as well. Now, consequences. Let's say that a company needs to maintain certain leverage ratios, or certain certain operating income ratios compared to interest expense. There could be some consequences if they don't meet that. They might have to put up additional collateral. They might see their available credit reduced. They could see an increased interest rate. They could see their overall terms of the loan renegotiated with a higher rate or shorter repayment schedule. Maybe they have to cut jobs, all right? Maybe they have to liquidate some assets and pay back some debt. In an extreme situation, maybe the lender could seize the borrower's business and auction it off to the highest bidder, more or less force it into bankruptcy. So you don't want to violate a debt covenant. Here's our sample companies right here. And we're first of all going to look at the leverage ratio, and the median is 1.8. So 1.8 is total debt compared to EBITDA. Which of these companies are going to have more debt compared to their EBITDA? And here is your answer. Now, if we want to talk through a couple of these at the extremes, Boeing and 3M we're going to talk about in a minute. But Xcel Energy, they have a lot of debt to finance all of their assets. They got a lot of fixed assets and infrastructure, as does Ecolab as an example. So they have high leverage ratios. High leverage ratios, that just means you have a lot of debt, right? And you might have higher interest rates as a result of it. On the other end, we see pretty strong companies, J&J, Apple, Amazon, not a lot of debt compared to their EBITDA. Now, out of these, Boeing has very little EBITDA, which made that ratio very high. So this doesn't mean that Boeing has a ton of debt, like compared to all these other companies. It has a good amount of debt, but it's just that its EBITDA is so small. And then 3M, again, I mentioned that earlier, they had a large litigation charge. If they wouldn't have had that litigation charge, their leverage ratio would have been 1.9, which would have put it smack in the middle of the other companies, a more normal ratio. So is low leverage always a good thing? Right? Low leverage, that means low amounts of debt. That's conservative. I don't say it's good. I think it's conservative. So a company would want to look, okay, could we actually maximize returns by having more leverage? What do we mean by that? Well, Monster Beverage, okay, these Monster energy drinks, they don't have any debt. All right. So all of their assets are financed by their shareholders, who probably want a return of about 8 to 10%. If they could issue debt for around 4 to 5%, get a tax deduction on that interest, and use that cash that they got when issuing the debt to repurchase shares, that would lower their cost of capital and might help them maximize returns to their shareholders. So it's tough to maximize returns if you don't have any debt. You're not going to go bankrupt if you don't have any debt, but it's tough to maximize returns. Well, the 8th review question here. A more aggressive company would want to consider what? So you're aggressive. A high current ratio, high leverage ratio, low leverage ratio, or equity greatly in excess of debt. Well, it's not a high current ratio. That's conservative. Low leverage ratios are conservative. Equity greatly in excess of debt is conservative. If you have a high leverage ratio, you're going to have a lot of debt compared to your EBITDA. As long as you can pay off all that debt, you're going to be in a good spot, because you've got interest expense at a lower rate than your shareholders want for their stock investments. But you got the risk at that point in time of bankruptcy, which is why it's not good nor bad. It's just more aggressive. Let's go on to efficiency ratios. Now, the efficiency ratios, we've got things like asset turnover ratios. Can we generate sales from our assets? Inventory turnover ratio, which is comparing cost of goods sold to average inventory. And then the one that I prefer to do is the days sales in inventory ratio, where you take 365 days divided by your inventory turnover ratio. And that's going to tell you how many days it takes to sell your inventory. Accounts receivable turnover ratio, credit sales divided by average accounts receivable. The one that I prefer is the days receivables ratio. 365 divided by the receivables turnover ratio. What does that mean as far as how quickly are you going to collect on your receivables? Well, days receivables, what's interesting, on this one is if someone told me, hey, Boz, I'm not even going to tell you the name of the company, but what are its days receivables? And I'd say, really? I can't get the name of the company? They'd say, nope. I would have said 30 days. And coincidentally, that's exactly what this median was. Now, I think that's a little dumb luck that it's exactly that. But it's just kind of where a company is giving its customers a month to pay. I think that's very standard, right? They're not demanding immediate payment because they want to have time to send a bill and get the customer time to get that processed, and also give the customer a little time to make money, to make sure that it can make payment on that bill. Well, here's what we can see with days receivables. So certainly ignore Target in this situation. They do not sell on account. An important thing to note that if Target sells and they collect credit card for that, that is not accounts receivable for Target. That is just like cash. They get cash immediately from the credit card company. The credit card company would have the receivable. So Target doesn't have any receivables. But I oftentimes think of businesses, right? When a business is selling to a business like Ecolab or J&J or 3M, you're having higher days receivables. You're giving your customers more time to pay. Boeing, I would have thought that, I don't know what I would have thought with Boeing. I would not have thought it was that low. But what we're seeing is that Boeing has a low days receivables because its customers have to pay as the work is being done. So we generally see higher days receivables when businesses sell to businesses, lower if it's just businesses selling to individuals and requiring payment within 30 days. Days inventories. If someone would have made me pick a day's inventory and they didn't tell me the company, but I knew it had inventories, I would have said 60 days. And again, kind of dumb luck that I'm really close on this one at 61.3 days. Here's the list of our companies. Let's think about which companies in here might have more inventories than others, especially related to their cost of goods sold. Remember that days inventory takes into account cost of goods sold and inventories, right? It's cost of goods sold divided by inventory. That's your inventory turnover. 365 divided by inventory turnover is days inventories. So who takes longer to sell their inventories? Well, we're going to skip United Health Group because they don't have inventories, but Boeing, right? We think about that one. Planes to build. That's on the high end of that side. And I'm going to talk through a couple, isolated ones on the next slide. But you think of like that Ecolab and Hormel and Target, the three right in the middle right there. So taking them roughly 2 months to sell their inventory. I was a little surprised with 3M actually that it was taking that long. Maybe their manufacturing process is longer. I don't know. I'd have to think about 3M. Boeing's planes, long time to build. And the customers pay as that goes along. So it's not like Boeing is out all that cash because the customer pays as the plane is being built, but its days inventories are very high. J&J, I don't know why that is so high. J&J's days inventories, again, was 147. So about the only thing is that, when they have a fairly low cost of goods sold. So inventories are a high portion of kind of a low number. But also, if you remember J&J, its gross margins were close to 70%. I think it was 68.8%. You cannot afford to have what we call stockouts if you're J&J. You can't afford to be short products because you make so much money when you're selling a product. You got to have plenty of excess inventory. if you don't make a whole lot of money when you're selling your products, it's not as big of a deal if you lose a sale. All right. Utilities. I didn't know if Excel would actually have inventories, but they can store their utilities. So Excel did have days inventories of about 48. And then Amazon Web Services. That one surprised me. Because I was like, well, they don't have inventories. All right, like their web services. Well, they also don't have cost of goods sold. So that's what. So their 40 days for Amazon for days inventories is probably just their distribution centers, right? Our low day inventories, are these always a good thing, right? Our low days receivables always a good thing. We think that if we can collect receivables quicker, sell our goods faster, that those are good. And in all else being equal, those are good things. But if the days receivables are too low, it's like, are we just not selling to enough customers? Are we not taking enough risks of bad debt? Because sometimes you got to take risks in order to maximize profits. In days inventory, if you don't have inventory on your shelves, you're gonna have really low days inventory. But if someone shows up to buy it and your inventory isn't there, they might buy a competitor's product, and not just that one time. Maybe they get hooked on that competitor's product for life. Well, what types of companies have the lowest days receivables? Those that go directly to consumers, businesses, loose credit policies, or significant receivables compared to sales. It's not businesses. They generally give them more time to pay. Loose credit policies kind of means relaxed. Now that could be collection issues, and customers might not be paying as quickly. Significant receivables, well, no, that's actually going to drive up days receivables. Companies which sell directly to consumers. Yep, those oftentimes are going to have the lowest because they're not going to give consumers or individuals as much time to pay. And then review question 10. What is not a risk of a high days inventory ratio? So if it takes you a long time to sell your inventories, which of these doesn't seem to be a risk? Obsolescence, spoilage, stock out, or thefts. So if you have high days inventory, which of these isn't a risk? Well, if you have a lot of inventory, obsolescence, it can get out of date. It can spoil. It can be stolen, but you are not going to have stockouts. You're always going to have plenty of inventories to sell to your customers. We're up now to our final section. We're at the market value ratios section. Variety of ones that can be used here. The book value per share ratio calculates the per value share of a company. Shareholders' equity divided by common shares outstanding. We got the dividend yield ratio, measures dividends basically compared to the market value per share of a company. That can be interesting. Just what percent returns does a company give in dividends? Earnings per share ratio, what are their earnings compared to the shares? That is widely used. We saw some of the press releases earlier. That's a huge one. And then price earnings ratio. What is the share price for a company compared to basically compared to its earnings per share? Well, I didn't really want to show these for our 10 companies because to me, that is kind of meaningless information. We can't compare earnings per share between companies. We could have compared it on individual companies over time, but you can't compare between companies. And the main reason why is a company can choose how many shares it has outstanding. All right, a company, like I could start up a side business and just have $100 of service revenues in a side business. Maybe I just start doing tax returns for people. I do one tax return, I make $100, and it's my own business, so I just say I have one share. Okay, so now I have $100 of earnings per share. Well, you could have another company like Apple that maybe is making $100 billion of net income, but it has, let's say, 2 billion shares outstanding because it chose to have 2 billion shares. Its earnings, and it could have like $50 of earnings per share at that point in time. does that mean I'm better than Apple? If I have $100 of earnings per share and Apple only has $50 of earnings per share, not sure if I misspoke, but I was saying that Apple would have $100 billion of net income, 2 billion shares, $50 earnings per share, right? Does that mean I'm better than Apple? I have $100 earnings per share. They have $2 earnings per share. Absolutely not. All right. Just I chose to have fewer shares outstanding. But the PE ratio, we can compare that between companies, and we can see a long-term trend in PE ratios here. This is the price of a company's stock compared to its earnings per share, all right, or market value of a company compared to total earnings. And we can see that over history where that basically sits, that it's been sitting kind of in that 20 to 30-ish range, right? This is now going back about 10 years. It's interesting to look at PE ratios by decade. And if you go to the bottom first on that one, you see the 1970s to 2024, the average PE ratio was about 20. In the 1970s, it was 13. Again, I'm going from the bottom up, which meant $13 of a stock price for every dollar of earnings per share. It stayed pretty steady there in the 1980s at 12. So from the 70s and 80s, PE ratios were around 12 and 13. But look at what's happened. In the 90s, stock prices started to go crazy, and they really haven't slowed down. 21 to 30 to 20 to 27. All right. So overall, it's been 20, but over the last 35-ish years, it's probably been closer to 25. So PE ratios have really exploded over that period of time. So the last review question I have here, the PE ratio from 1970 to 2024 has averaged about what? Just kind of went through it on the previous slide. So can you remember what this one is? Well, as we take a peek at that one, it's not 12 to 1. That was more back in the 1980s and then the 1970s. It was pretty close to that as well. It's not as high as 30 to 1. That kind of hit in the 2000s. It's not as high as 38 to 1. That was a peak in late 2020 and in early 2021. And what we basically had is we had a lot of companies that had bad financial results, bad earnings per share due to COVID. The stock market crashed right away, but then it very quickly rebounded. All right, so over the last 54 years, it has averaged right around 20 to 1. Well, that's what we got. I hope you learned a lot about analyzing financial statements using ratios. We'll see you in another lesson. Take care, everyone.